Everybody, we tried to do this on YouTube Live today, and we apologize. We had a few technical difficulties, so Imran and I decided to record our video chat on Zoom, and then we're going to post that up on YouTube to hopefully make it up to everyone. And then, of course, we're going to try a live maybe tomorrow. Only I'll get the software straightened out. Unfortunately, as an options trading guy, I am not a good technical video operator. So how you doing, Imran? By the way, everybody, this is Imran from Options Insight. He's one of our good friends, and we're going to talk about the meme stocks and implied volatility in particular in the dynamic into options expiration tomorrow. We're seeing there's a lot of information out there right now about options and gamma squeezes, and some of that's good, but we think some of it's rather misleading. And so we want to talk about some trade ideas, the volatility surface, and what we see in the markets right now. So how are you doing, Imran?
Yeah, good. Thanks for having me on, mate. Good to see you. Crazy volatility going on.
It is, man. I think I got us all off kilter because I don't know how to work video very well. So on the screen here, we're looking at this is the bookmap trading system, and we're looking at AMC actually. And so you can see that on the top, this is the price action in AMC, obviously. And then down below on this green line is our options indicator called Hero. And this is actually showing us the real-time options flow. It's the delta off of the real-time options flow. So the fact that this number is below zero is telling us today that options people are either buying puts or selling calls, right? One of those two combinations. And the other interesting thing I want to note here, and I want to get your comments on this, is that we had two strikes that we were paying attention to into this morning. We put these up on our blog. 40, which is the largest call open interest line, and then 60 was the high gamma strike in the name. And there's something like 40% of gamma expiring on tomorrow's close. So that was the basis for trading today. What's your sort of basis, or what are you kind of seeing now with implied volatility and the way the name's trading?
I mean, so it looks like so people have piled into a bunch of 40 calls. Then we smashed through yesterday, and they've just gone and bought higher calls, right? That seems to be what's gone on.
Yeah.
So they just keep rolling their strikes up, but rather than pushing it further out into longer maturities, they seem to be just concentrating on tomorrow, right? On Friday this week. I mean, personally, I think that's a pretty risky strategy because your premium could just go pop in the night.
Getting long calls is a risky strategy.
Yeah, it's just, I mean, you're really putting all your premium down into one very concentrated bet. And it seems to work because they're all doing it together, like an army, like a coordinated attack, right? That's why these gamma squeezes tend to kind of work initially at the very least, because they're all doing the same trade. They're doing it in monster size, and the guys who are selling it to them have to buy stock against it. And that volume of stock is just too big to not move the price.
Right.
And as it moves the price and you get closer to the strike, the delta of the option grows and creates more need for more purchasing. And we get what is called the gamma squeeze. And that's happening. I don't need to explain that to you, right? But more for the audience's benefit. But I don't know. I just think there is obviously a big risk that if we don't break through that 73 strike, which I guess is the one that they've all piled into most recently.
Yeah, and that was the high strike available. So that's basically where the stock topped out yesterday, was where the highest options call strike was available. Stock topped out, I think it's 72 and change, and then sold off. So it's quite a coincidence.
So, I mean, like you saw last week, you had a similar phenomenon where we squeezed into Thursday, Friday. And then what did we sell off on the Friday? Did we sell off on the Monday? But we basically gave a load back, right?
Yeah, so it was kind of interesting because what we see happen is on Monday, Tuesday, everyone rushes into the calls that expire at the end of the week, right? So on Tuesday, let's wind it back. Last Monday, everyone rushed into calls, right? And then on Friday, the stock gapped higher in the overnight. It opened at 35 roughly on Friday morning and then tanked down to 26. 26 and change. 27 was what we call our high gamma strike on Friday, right? And so in our view, all of the calls that got bought during the week just burned up, right? They light on fire because of time decay, and the market makers can sell off those positions. So now we're looking at this setup again here today, where that's what we say when 40% of the gamma is going to expire tomorrow. That's telling you that like almost half of the options position effectively is going to expire at the close tomorrow. And so the at the money call right now, which is like the 58 strike call, is going for $8. And like, yeah, the stock can move that much, but the risk on that trade is just, it's kind of crazy, especially is because time decay is just really going to start working against you.
Yeah, but I mean, I think we need to think about the psychology of the people who are long and the people who are short, right? So the people who are long, it's a punt, right? They buy it, they spend the premium. The premium goes to zero, they live with it. They're not going to panic and sell it. They're just going to let it die. And if it goes up and is worth a load of money, then at some point they're going to sell it to take profit, okay? And buy something else. That seems to be the MO, right? That they're operating under. Now, the market maker on the other side, who's getting lifted out of this stuff, is being forced to just delta hedge to try and mitigate losses, basically, right? So every time stock rallies, they have to buy a bit of stock. Every time it sells off, they've got to bang it back out again. Today must have buried the market makers, because we literally went from 65 down to 40 and back up to 70 again. I mean, these moves are ginormous moves. Even if the stock's on a 400, 500 vol, which it is, the market makers are getting eaten alive right now. So it's pretty painful. Now, so if you're telling me that a load of options are expiring on Friday, that says to me that unless those options suddenly get rebought the very next week immediately, the market's going to have a bit of a period of calming down a bit, basically. At the moment, that position is exacerbating the vol, and that's what we get in these crazy intraday swings. Once that goes away, I would expect... well, the problem is no one knows what the hell the stock's worth, right? So you'd expect some equilibrium and some stability, but that's if everyone knew what the stock was worth. I don't think any of us do, right? So that's the flip side.
I agree with you on that. So, what I think is the interesting dynamic here is that when you're buying calls on Monday, Tuesday, and Wednesday, right? The flow is in your favor, right? Vol jumping. I mean, the stock is literally crashing higher. When it goes higher, implied vol goes higher. That's something that you usually see when a stock crashes, right? So if you're buying calls and implied vol goes up, man, your long options and the stocks, your long calls and the stocks going up, vol's going up, you're making money. That feels great, right? And then I think on Wednesday, really Thursday and Friday, that dynamic changes because of the decay, right? Because the time decay starts to work against you. So you have a tailwind Monday, Tuesday, Wednesday. Everyone's buying calls, stocks going up, vol's going higher, so you're making even more. And then decay kicks in, right? And the stock seems to weigh down by this flow.
But what you're basically saying is, I mean, the decay is there every day, but what you're saying is that in the Monday, Tuesday, Wednesday, the decay is being offset by more buying, basically, right? So the vol is ratcheting higher and higher to offset the decay. So the price of the calls doesn't drop, it just keeps going up. Right? But when that buying dries up, because everyone who wants to buy it has already bought it, then you've got to be honest and you've got to pay your theta bill, right? And that's where, when you're sitting on a call on a 500, 600 vol, that theta bill is pretty hefty, right? So and that's where that premium starts to come in, and calls are no longer such a great position, basically.
I mean, the at the money right now, which is now the 60, it was 58 since we're talking, it's 541 according to Thinkorswim. So the point is too, when this vol gets jacked to such a level, we were talking about this before about realized versus implied vol. Realized is like a 400, I think, right now, and implied is trading 500 or 600. So those options are expecting or pricing in more volatility than that has already taken place. So that's the other issue here, is that more and more and more vol, stocks already gone up 500-600% in a week. So to me, it's a time cycle. Monday, Tuesday, Wednesday goes in your favor, vol expands. The time is in your favor, and then as we get tick closer minute to minute to the Friday expiration, that time starts to kind of work against you in a way. And let's look at quickly. I have GameStop here, and then I'd like to see what you talk. I would like to share your screen, and you could show the implied volatility surface and talk about some trade ideas when volatility is this high.
Sure.
So forgive me, I'm gonna turn off this setting quickly. So this is the game. This is GameStop flow today, and GameStop, it's been moving a lot. Don't get me wrong, but this is the exact same thing that we see in AMC, and I'm gonna show BlackBerry in a minute. This is all bearish options flow, right? Put buyers, call sellers, one of the two, and you can see how the stock just comes really straight down. The stock comes straight down off the highs here around 2 o'clock. This bearish flow comes in, and the stock gets pushed straight down. This has a ton of gamma expiring on Friday as well. So these are all the same situation. These meme stocks. Here's BlackBerry. If we pop over that stock, this flow turned bearish. After the stock hit sort of 20, this flow turned bearish. You can see how the stock trades down right with that bearish options flow, and then it's more or less just kind of traded sideways. So I think the other thing is that the volume, at least last Thursday, was over 2 million contracts. Yesterday we had 2.8 million calls. 2 million calls last Thursday, and then Friday will put up a number like 1 million calls, right? The trade is kind of over for the week, I think, when we run into Friday, really kind of from our view. Do you want to show, I'd like to talk quickly about the vol surface, because I never see anyone really talk about this. You want to share your screen, and then we'll pick up with looking at the vol surface a bit.
I think you need to stop sharing.
Yeah.
To do that. Yeah, okay, great. All right. So, I mean, this is like, obviously it depends on what brokerage platform you use, right? This is one of the ones that I use called Interactive Brokers. And this is called the Volatility Lab. So, for any asset, any stock, any index, you can like bring up these sort of analytics. What it basically allows you to do is kind of have a look at recent history. And for now, I've got it set for 2 months. And you can pick a bunch of expiries and you can see where the implied vol has been and where it is now, and also where the underlying asset has been, which is a little bit hard to see because it's like dark in the background. Yeah. You can see the underlying asset was around $10, and it's obviously AMC's. We're looking at AMC now, right? Yep. And in recent week, it's gone from like $10 up to $60, right?
Yeah.
What has the implied vol done across different tenors? And all these, I've got June, July, September, and December expiries up here, and all the vols were kind of hanging around the 120 area, and they've exploded pretty dramatically in the last week, literally the last couple of days, to levels that are just astronomical, right? So you've got June volatility at 460, got to highs of 540, and let's just be clear what that means.
That's crazy.
Right? 540 volatility, right? For anyone who doesn't know, all you got to do is you've got to divide that number by 16, and that equates to 34% per day.
Right. That's the rule of 16.
So that's saying that the market thinks, or the market, well, whether the market thinks or not, but the flow has got to such a level, the price has got to such an expensive level that 540 vol means that up to that expiry, which June is like in another couple of weeks, we expect this stock to do 34% every day.
Right.
Okay. That's how dramatic that pricing is right now. I mean, yeah, of course
it's incredible.
It's unbelievable, right? And I mean, it may do it, but
yeah.
I don't know. Odds are not. I think the odds are against
the issue. The issue too is it's not sustainable, right? Like we've had a chain of those moves, and it's really musical chairs. Like, yes, it worked last week. Okay, it's going to work again, but the odds of that working next week or the week after, decrease, I think, significantly. That you continue to have those kinds of moves because of margin calls or even exogenous events. Let's even if retail or whomever it is can keep playing this thing.
Or what we just said, right? That a load of the gamma is going to expire, and if that gamma isn't reloaded, if people don't go and burn a load more premium in next week's calls, then the market isn't as short gamma and doesn't need to necessarily move as wildly as it's been moving, right? So there's going to be, like, I call it the gravity of volatility, right? When it's like you're throwing up a stone, that stone's coming back to earth at some point, right? So, generally vol traders who have seen vol and traded vol for many years, they know when you get vol spikes like this, it's inevitable that it's coming back down. So, you generally want to find smart ways to sell it, not buy it.
Yeah, and that's a great segue. And on that, I want to bring up one data point. I don't know if you're aware of this, right? But we traded 2.8 million calls yesterday. But call open interest actually went down a little bit. It decreased, which is amazing. I mean, if you're going to tell me the stock went up 95% yesterday, and there was 2.8 million calls, which incidentally, we looked at all the stocks, one day call volume. Going back to 2005, that was the 50th highest call volume for a stock since 2005. So that ranked 50th, that number 2.8 million. So that was an incredible day yesterday.
That must mean that a lot of that volume was profit taking and closing down positions, right?
That's exactly what it says to me, right? Because you're going to trade that much, stock moves that much, but you have to be kind of crazy in my mind to have a 95% up move like that. Options are returning exponential returns that anybody should be excited with, and a lot of people are saying hold the line. Like, man, you just made 500% in 5 days. That we used this analogy before. Like, that's like getting struck by lightning and winning the lottery on the same day, and then you're going to expect that to happen.
Yeah, and then wanting to win the lottery again tomorrow.
Right? Like the odds of these things.
That's quite funny.
Yeah. So
I mean.
So I'd like to ask you. I'd like to ask you two things, right? At some point, these trades get passed off, I think, from a retail trade to quote unquote professionals, right? And the biggest, the guys that are licking their chops to me are the vol shops, right? Or even some dispersion traders, because you have the IWM, Russell Index, which is now tracking, that AMC and GameStop are such a big part of. So I like your, how would a vol shop play this, right? Like, if you could kind of lay it out for people. Not only that, like what kind of trade would you put on?
Well, so I mean, there's various things to think about, right? Do you want to play directional combined with volatility, or do you just want to trade straight volatility, right? So let's start off with straight volatility, yeah? So, one thing that we look at a lot as vol traders is what we call the term structure.
Mm-hmm.
So this chart here at the bottom here just plots the implied vol of AMC for at the money options across all the different expiries.
Right.
You can see it's very, very downward sloping. It's called a backwardated or inverted term structure.
And that's usually something, not to interrupt you, but you usually see that when stuff is crashing, not really when
Correct.
It's going up.
Yeah. I mean, when stuff's very volatile, that's what you see.
Right. So like the people often talk about the VIX being backwardated, and that's what happens when the market crashes, because everyone looks for the cheapest put protection they can, which is generally front month puts.
Exactly. And so you look at that and you've got kind of June, July stuff, anywhere between 450 and 400 vol, let's say. And then you look further out and you've got December at like 200, something like that, right? I mean, it's not often you can say that a term structure between 6 month different tenors is 200 vol points. I mean, that's insanity.
Yeah.
Right? So a vol arb guy will be looking at that thinking, maybe I want to be short some of this short dated stuff. So maybe you don't go all the way out to December. You want to try and keep it a bit localized between the two expiries, but maybe you can like buy some September vol and sell some June or July to try and play that curve coming back down, which it most likely will once we find some stability and equilibrium, right? So that's one potential vol arb trade that people might be looking at. A safer way to sell volatility is probably to do things like iron condors, which are where you sell call spreads and put spreads that are out of the money and you collect some premium. But if the market moves extreme either way, you're going to lose a little bit, but you're not going to lose your shirt, right? So that's another way to sell vol, but in a more contained manner. And then if you've got a directional view, you can kind of skew it towards that as well. So for example, earlier today, I even suggested to you, we were having a chat, right? And when we were down at 40, 45 in the stock, I was looking at the shape of this surface, and this thing here is the skew surface, right, in June. And I was seeing that the steepest part of the skew surface was between, say, the 30 strikes and the 20 strikes. And it really collapsed into that, and the bottom of the vol was kind of around that 20 area.
Yeah, so can you explain quickly what that skew surface is showing? Because I think a lot of people would be curious, exactly what that's saying.
That skew is saying, so you can pick the expiry, but this expiry is June, so like 2 week options.
Yep, June 18.
Yeah. And you've got, on the x-axis, you've got all the different strikes, the June expiry strikes, and on the y-axis, you've got the vol, the implied vol. So you can see that normally in equities, you have high vols on the put side and you have low vols on the call side.
Right, because people mainly want to buy downside protection against long stock hedges.
But in names like this, you have completely the opposite, where you have the market is currently here at 56. Calls are trading at a high vol and puts are trading cheaper. But then you see these deep downside puts like sub 10, they go back up again.
Right.
So you've got this weird kind of skewy smile thing going on. But basically, the thing this says to me is, I don't know why it disappeared then, but the thing this says to me is, if I can sell like 30 or 25 strike puts and I can buy the 20 puts against it, I'm getting some edge because I'm collecting some of that expensive skew as well. and I'm getting to basically say, like, underwrite the market and say, by June, which is in 2 weeks' time, I don't see this thing dropping below 20. If I'm right, I'm going to receive $2. If I'm wrong, I'm going to give away $3.
Right.
The put spread cost about 2 this morning, basically.
Right.
Now, after we rallied back up again to 60, the put spread halved in value, so you already made that.
Because you had the vol leak off as well as, you know, as the delta, right? Because the delta goes higher, so the puts lose value. But then also the vol comes down.
Yeah, you've got a long delta position, so you want the stock higher. You've got a short vol position, and you've got a skew position that's working in your favor because of the way the skew is priced. So a lot of things are making the premium of that put spread look quite attractive to sell, basically, right?
Right.
So you can have a situation where even if the stock dumps another 30% in the next 2 weeks, you might still lose no money, basically, right? Because the price of that put spread will not change very much, even if we go towards the put spread, because it's so damn expensive already because the vol is so high.
Exactly right. So almost like when you buy a put and the market rallies, right? The put loses a ton of value. In this case, you know, because the stock is crashing higher and the market sort of comes down, the put could actually gain possibly in value because volatility should come off when the stock, in other words, comes back down, right? Because volatility should mean revert from 500 down to 300 when the stock goes from, say, you know, 50 or 60, 50 down to 30 or 40, right? If that happens.
Yeah, it's about, are we going to a place of more volatility, or are we going back to a place of more stability?
Yeah. So I want to say this a little bit of a cleaner way, right? If you sell a put right now, and this is not investment advice, it's just something to really consider. Because this volatility is so high, and this is a trade that I've been looking at, and we talked about this before with your put spread, the implied volatility is so high, and when the stock crashes, when the stock goes up, it's crashing higher, volatility spikes. So if the stock sells off, implied vol should come down, and your put could actually make money, even though the stock comes down.
Yeah, and this is quite unusual, right?
It's very unusual.
Normally, for those of you, you know, the Greeks of options, the main Greeks are delta, gamma, vega, and theta, right? But generally, the predominant Greek is delta. Then after delta, you have vega, right? And vega is about what the vol is doing, what the implied vol is doing, and delta is about what the spot is doing. And normally, as Brent says, is when a stock goes up, vol normally goes down.
Right.
And when a stock goes down, vol normally goes up. Okay. And what we've had is this weird situation where the stock has gone up dramatically, but vol's gone to astronomical heights. And because of that, you've got this kind of opportunity where you can sell put options, which normally in a crashing market would increase in value due to their delta, and would also increase in value due to the vol going up as well. But we've got a situation where we might get a pullback in the stock of maybe from 60 back to 30. So maybe even 50% pullback in the stock. But if you sold like a 10 strike put in December, you might find that it barely increases or doesn't even increase or decreases in value, because in a 50% drop, even though we've dropped and got so much closer to the strike, the vol has gone from like 300 or 200 to 100 again.
Exactly.
And that collapse in volatility has offset what the delta's done, and it's just been a good sale, basically. It's just been a good thing to be short.
Right. So if you visually, you can think about this on the top left implied volatility monitor that you have there, where, you know, the green, yellow, and blue lines. When vol goes back, at some point it will, from 475 down to, you know, 100 like it was before all this happened, your put option, all else equal, is going to make a bunch of money if you sell that put, if you're short that put, right?
Yeah, I mean, but let's bear in mind the 400 is the super short dated, right?
Oh, of course, yep.
And that short dated, I mean, your option's probably expired by the time. I mean, it's going to take a while for vol to go back to 100 at the front end, right? But the longer dated stuff like September and December that are at 270 and 220, for sure, within a month, if this blows over, they could be heading back to 150 or even 125 quite easily. And that's nearly a halving of vol, right? Which is pretty dramatic.
Yeah.
So yeah, I mean, you're better off for that sort of naked trade where you're just going to sell that put and just be like, that put's just not going to go up in value.
Right.
Yeah, you'd be going longer out, I guess. Right.
Yeah. And the other thing here to note, you know, when you sell a put, obviously you know what your downside risk is, right? Is if the stock goes to zero. Now, AMC sold earlier this week $250 million roughly worth of shares, right? That made headlines. And then last night they announced they're going to sell another 11 million shares, I think at 55. So these guys have raised close to $1 billion now this week. So if you're going to talk about the ultimate downside of the stock, zero just seems like it should be taken off the table for right now.
I mean, the point is, if it didn't go to zero on COVID
right.
before all this shit was happening, why the hell is it going to go to zero now, right? Like, yeah, I totally agree with you.
So your downside is somewhat limited, and the vol should come down. So if you think the stock's going to go up, it also selling puts or put spreads makes sense, because if the stock keeps going up, if the stock goes from 50 to 400 or whatever, then that position should obviously profit a little bit as well.
Do you want to share any more?
I'd like to show. I kind of just want to show one more thing here, and then we will. And then we'll move off here. So what we're looking at again for tomorrow, and again, I think the dynamics at play here are we're kind of going to get squeezed tomorrow due to this open interest, but this is what we call our equity hub tool, and this shows where all the key options positions are. So on our blog post at spotgamma.com, you go to this blog here and you can see this data that we set up this morning. But this is the number, right? 41% of Gamma is set to expire on the close of tomorrow, which is 6/4, so that's 4 p.m. tomorrow Eastern Friday. And it's these two big numbers, right? 60 and 40. This is, if you're going to talk about the center of hedging flows, right? This is where they are tomorrow, in my view. This range between 60 and 40. It's a big range, but I think kind of like yesterday, the stock will likely settle into that area. And then when it sort of trades sideways, because implied vol is so high, as soon as the stock kind of just trades sideways and cools off, implied vol drops hard, right? It's just the fact of, I use this analogy all the time, like a shark stops swimming and it sinks to the bottom of the ocean. Implied vol, when the stock stops moving, because implied vol is so high, implied vol is really going to, come down kind of hard. And that's kind of the basis for, what I've been talking about happening, this dynamic on Thursday night into tomorrow. And, you're suggesting put spreads and condors are a great way to take advantage of any volatility coming off as well.
You froze for a few seconds.
Oh, it did. Okay. I can edit. I'll be obviously editing this out.
Okay. But then, so do you think then it's likely that the market stays between that 40 and 60 range tomorrow? Is that what your screens are basically kind of suggesting?
Yeah.
And is there a trade there? Like, I mean, it's punchy, but would you sell that strangle? Would you sell that one-day strangle, 40, 60, basically?
Yeah, well, a condor, I would never trade this thing. I would never sell a naked call, I'll put it that way. So, I would like to sort of define my risk, but if you want to put that out, so like if I sold the 40-35 put spread, that's going for only 70 cents, so that's not a whole lot. And then the 60-65 call. So that condor, if you wanted to trade the $5 condor, sell the 60-65 call spread, sell the 40-35 put spread, that's going for about $2.50 right now.
Okay. That's an even money bet, basically, right?
Yeah.
It's even money. It's like you make 2.5 or you lose 2.5.
Yeah. And what's kind of cool, the other thing that's kind of cool about this, because the stock whips so much, is that, if the stock for some reason drops this afternoon way through one of those ranges, you could take the short end of that, trade off, and then you kind of have a naked, call or put there, kind of a free naked call or free naked put there, long, of course, as something of a lotto ticket. So it's kind of an interesting trade. But the last thing I just want to mention before we close out is what the open interest looks like for today, based on today's information. So this is always crazy. So the 73 strike calls that expire tomorrow, if you're the open interest in those is 44,000. What do you think the volume is for today on that strike?
I have no idea. 100,000?
123,000. 123,073 strike calls traded today. They're currently at $4. So this volume is way off of yesterday. A lot of these strikes are trading over 100,000 each. I guess we still got another 45 minutes in the day.
But that shows there's been a lot of unwinding of that position.
That's what I believe. I think, back to this hero indicator we were looking at before. Hopefully you can see it up on my screen now. If we go back to AMC, there's not bullish options flow, punching into this thing at the moment. It's still, it's come up off the lows, but it's still bearish flow, right? The call buyers are not stepping in today like they were yesterday.
Yeah.
So,
okay.
All right, Imran. I know it's very late there. Thank you for taking the time to chat with me today. I'd love to do this again. Hopefully, we can do this again maybe next week or even tomorrow if things just get bananas again. And I'll get my streaming sorted out. So, can you quickly tell people how they can find you and get to your site?
So best way to find me is probably Twitter, Options Insight, Options_Insight. I also have a YouTube channel, same thing, Options Insight. And I'll talk about all things sort of volatility. I'm a sort of ex-Wall Street trader, grown up trading options for 20 years, and now I teach people how to trade options. So I run courses. I have a subscription service where I help people, guide people through trading and stuff like that. But yeah, just connect with me. We'll have a chat. And yeah, that's it really.
Awesome. Thanks, buddy. Enjoy the rest of your night.
Cheers, man.
Talk
Take
soon.
care.